Recently, global tensions have been rising again. What started as ongoing conflict in one region has quickly escalated into a much bigger situation. Multiple countries are now involved, and the situation is evolving fast. While the details are still developing, one thing is clear. Events like this don't just stay local. They affect global markets, they affect energy prices, and they create uncertainty across the entire system. And when uncertainty increases, markets react. Investors start to rethink risk, capital starts moving, and strategies that worked before might suddenly stop working. And that's exactly why understanding how to respond in moments like this is so important.
Right now, there's a lot of debate around what's happening. Different opinions, different perspectives, and a lot of uncertainty. But from a financial point of view, there's one question that matters most. How does this affect the global economy? Because even though this situation might seem far away for many people, the impact doesn't stay local. And that's what often surprises people. You might think, if a country is relatively isolated, then the global effects should be limited. But in reality, modern economies are deeply connected through energy markets, trade routes, and financial systems. So when instability appears in one region, it can quickly spread through the entire system. And that's why economists and investors are paying close attention right now. Not because they know exactly what will happen, but because the potential impact could reach much further than expected. So in this video, I want to break down what this could mean from a financial perspective and why even people far removed from the situation might still feel the effects.
So to understand why this matters, we need a bit of context. Iran is not a typical global economy. For years, it's been under heavy economic restrictions, which has limited its access to global trade and financial systems. Because of that, its economy operates differently compared to most developed countries. It's more isolated, more dependent on specific sectors, and more sensitive to external shocks. And one of the biggest factors here is energy. Despite being economically constrained, the country still plays an important role in global oil supply. And that's where things start to connect to the rest of the world, because energy markets are global, and even small disruptions can have ripple effects across multiple economies. So while the country itself might seem relatively isolated, its influence on certain key markets is much larger than it appears. And that's exactly why investors are paying attention right now.
Now, here's where things get more serious. Even though Iran is relatively isolated economically, it still plays a noticeable role in the global oil market. And that matters, because oil is one of the most important resources in the world economy. Over time, the country has found ways to continue exporting oil, even under heavy restrictions, which means it remains part of the global supply, even if not always in the most visible way. And whenever tensions rise in this region, markets react almost immediately, because investors start pricing in a potential disruption in supply. And that usually leads to one thing: higher oil prices. But the bigger concern isn't just about one country. It's about a critical location that connects a large portion of the world's energy supply. There's a narrow shipping route in the region that acts as a gateway for oil moving into global markets. And a significant share of the world's oil passes through it every single day. So if anything disrupts that flow, the impact isn't local, it becomes global. And that's why even the risk of disruption can move markets so quickly. So now you can see why this region matters so much. It's not just about one country. It's about a key route that a large portion of the world's oil depends on. And when there's a risk that this flow could be disrupted, markets react immediately. Because even the possibility of reduced supply is enough to push prices higher. And once oil prices start rising, the effects spread quickly, not just in one country, but across the entire global economy. Because oil is everywhere. It powers transportation, it supports production, it's built into the cost of almost everything. So when energy becomes more expensive, businesses face higher costs, consumers pay more, and economic pressure increases. And that's why situations like this are taken so seriously. Not because anyone knows exactly what will happen next,
but because the potential impact can reach far beyond the region itself.
And the impact doesn't stop at oil prices. When energy becomes more expensive, it affects almost everything. Transportation costs go up, shipping becomes more expensive, and that increase gets passed on through the entire supply chain. So even products that have nothing to do with oil directly can still become more expensive. Now, it's important to understand that this system isn't completely dependent on a single route. There are alternative ways to move oil to global markets: pipelines, different shipping paths, infrastructure that's been developed over time to reduce risk. So it's unlikely that supply would suddenly disappear entirely, but that doesn't mean everything is stable. Because even with alternatives, there are still vulnerabilities across the system. Infrastructure can be disrupted, transport routes can become unstable, and when multiple risks appear at once, even a partial disruption can have a meaningful impact. Which brings us back to the bigger picture. This isn't just about one event. It's about how fragile global systems can be under pressure.
So the impact goes far beyond oil. This is where things start to affect the global economy more broadly, because it's not just one resource at risk. The same region is also critical for natural gas, which is used for electricity, heating, and everyday energy needs. So when supply is disrupted, prices can rise quickly. And just like oil, those higher costs spread through the system. There are also ripple effects in other areas. Key materials used in agriculture can become more expensive, which then impacts food prices. Transportation and logistics become more complicated. Flights get rerouted or canceled, shipping becomes more expensive, and insurance costs increase as risk rises. And when companies face higher risk, they become more cautious. Some delay investments, others reduce activity in the region, and that slowdown can affect entire economies. For countries closer to the situation, the impact is even stronger. Government revenues can drop if exports are disrupted, economic activity slows down, and inflation can rise. At the same time, money tends to move away from uncertainty, which puts even more pressure on local markets. And that's how a regional conflict can turn into a global economic issue.
So when you put all of this together, the impact becomes much clearer. For countries in the region, the risks are immediate. Key industries can be disrupted, infrastructure can be threatened, and government revenues can take a hit. But beyond that, there's a broader global effect. Higher energy prices, rising costs across supply chains, and increased uncertainty in international markets. And the longer a situation like this lasts, the more those effects start to compound. Because markets don't just react to what's happening now, they react to what might happen next. And when that uncertainty stretches over time, it can slow growth, reduce investment, and put pressure on economies worldwide. Now, of course, the exact outcome is impossible to predict. Some scenarios remain limited, while others could escalate further. But history shows that conflicts like this don't always stay contained, and that's why investors are watching closely. Because even if the situation seems distant, the financial impact can reach much further than expected. So the next question is, what does this actually mean for major economies like the United States?
Now, when it comes to the US specifically, things get a bit more complicated. There's a common belief that periods of conflict can actually boost certain parts of the economy, and in some cases, that's partially true. Government spending tends to increase, and certain industries can benefit in the short term. But that doesn't mean the overall impact is positive, because at the same time, there are real economic pressures building underneath. One of the biggest is inflation. Higher energy prices, increased spending, and disruptions to global trade can all push costs higher. And when inflation rises, it creates a chain reaction. Interest rates can stay higher for longer, borrowing becomes more expensive, and economic growth can slow down. At the same time, investors start shifting their behavior. Some move into safer assets, while others react to inflation risks, and that creates volatility across markets. There's also the issue of government spending. During uncertain periods, spending tends to increase, which can put additional pressure on long-term financial stability. So while there may be short-term benefits in certain areas, the broader picture is far more complex. And that leads to the next question. What does all of this mean for the stock market? I won't go too deep into stocks here, but there's one important point worth understanding. In the short term, markets often react to global events. You might see volatility, sudden drops, or sharp movements. That's normal. But over the long term, things tend to look very different. Historically, stock market performance hasn't been driven mainly by geopolitical events. Instead, it's influenced more by fundamentals, things like earnings, growth, and economic conditions. Which means that while headlines can move markets in the short term, they don't always define long-term outcomes. That's why reacting emotionally to breaking news can often lead to poor decisions, especially if you're investing with a long-term perspective. Because the reality is, no one knows exactly how situations like this will unfold, and trying to trade every headline usually creates more risk than opportunity. So instead of focusing on short-term noise, it often makes more sense to stay consistent with your overall strategy, which brings us to a few final thoughts.
So that's the situation as it stands right now. But it's important to remember, this is still developing. Things can change quickly. Governments can step in, supply can adjust, and markets can react in ways that are hard to predict. For example, there are already efforts to stabilize the situation, including measures to support energy supply and keep key trade routes functioning. And in some cases, other producers can increase output to help offset disruptions. So while the risks are real, there are also forces working to balance the system. The bigger uncertainty is time, because the longer a situation like this continues, the more pressure it puts on global markets, and the harder it becomes to contain the impact. At the same time, broader global dynamics can influence how things unfold, and that adds another layer of unpredictability. So while we can analyze the risks, we also have to accept that not everything can be forecasted, and that's exactly why staying flexible matters more than ever.
If history tells us anything, situations like this rarely resolve quickly. Even if things change in the short term, there's often a period of uncertainty that follows. And that uncertainty is what markets tend to react to the most. So for now, all we can really do is watch how things develop, not trying to predict every move, but understanding the bigger picture. Because in moments like this, awareness matters more than certainty. If you found this helpful, there's another video where I break down how global events impact markets in more detail. And if you want to follow along as I continue analyzing these kinds of shifts, consider subscribing. I'll see you in the next one.